Let us see the next question. HMR Limited is considering replacing a manually operated old machinery with a fully automatic new machinery. So it is considering replacement of a machinery. The old machinery had been, highlight the portion, fully depreciated for tax purpose, but has a book value of rupees 2,40,000. Dear students, whenever the two WDVs are given, one is from tax point of view and another is from accounting book value point of view, then always the accounting book value is irrelevant. The machinery has begun causing problems with breakdowns and it cannot fetch more than 30,000 if sold in the open market at present. So if it is sold in the market right now, it will fetch only 30,000. It will have no realizable value after 4 years. So if it is used further for another 4 years, it will not have any scrap value. The company has been offered rupees 1 lakh for the old machinery as highlight the portion trade-in. Dear students, the term trade-in stands for a kind of exchange price on the new machinery which has a price. Highlight the portion further. Before allowance for the trade-in is 4,50,000. So purchase price of the new machinery will be 4,50,000 and sale value of existing machinery will be 1 lakh if at all we go for the replacement. The expected life of the new machinery is again 4 years with salvage value of 35,000. Further, company follows SLM, straight line method of depreciation, but for tax purpose, again highlight the portion, WDV method of the depreciation at 7.5% is allowed, taking this only machinery in the block of asset. Means this is the only machinery in the block of asset and this straight line method of depreciation information is given once again to misguide us. Always remember that the method of depreciation as per income tax is relevant. Given below are the expected sales and the cost from both old and the new machinery. Sales is given, material cost is given, labor cost is given, variable overhead, fixed overhead, depreciation, profit before taxes, income tax, profit after taxes is given. Analyze from above information, analyze whether the old machinery should be replaced or not. If the discounting rate or the required rate of return is 10%, highlight the portion, ignore capital gain tax. 10% factors have been given to us in the question. I request you to go through the question, please. Friends, again over here, we are required to take decision regarding the replacement. This time we are going to adopt the incremental approach. So write down heading, adopting incremental approach for decision making. In the write down, step number 1, investment. Dear students, it is obvious that say we are talking about the incremental investment. Please write answer in the chat box, amount of incremental investment. Dear students, the amount of the incremental investment is 4,50,000 minus 1 lakh. That is what we understand. So please write down answer. Purchase new machinery. $4,50,000 less sale existing machinery It is an amount of 1 lakh. Because the question is providing that say you'll get the trading for the existing machinery 1 lakh. So of course the 30,000 rupees of the value which is given to us in the question is of no use. So investment would be 3,50,000 incremental in the year 0. Step number 2, depreciation. Of course, when I write the depreciation, I am talking about the incremental depreciation. Incremental depreciation. I request you to write answer in the chat box that what would be the incremental depreciation just for first year. So write down answer. Working note number 1, calculation of incremental value of block. It is calculated as purchase price of new machinery minus sale value of existing machinery. Purchase price of the new machinery is 4,50,000 minus sale value of existing machinery is 1 lakh. That comes to 3,50,000. Simple. See, if at all we go in a very systematic manner, then in that case, what is the amount on which you can claim depreciation? If at all we replace, it is 0. Why? Because the income tax WDV of the existing machinery is 0 plus 4,50,000 minus 1 lakh. This is the amount on which you can claim depreciation. Otherwise, you would not have claimed it. That is the way it is once again 350. Next, working note number 2, calculation of present value of depreciation. Of course, the incremental. Why present value? Because later on we will not make the computation of the CFAT by deducting depreciation add back. That is the reason. So first year, second year, third year and fourth year. Opening WDV, depreciation, present value factor, present value depreciation. So it is 3,50,000 into 7.5 percentage, 26250. So 3,23,750 into 7.5 percentage. So 24,281.25. It is deducted from 323,750. So it comes to 2,99,468.75 into again 7.5 percentage. So 22,416.15. I am writing up to 2 decimal. 2,99,468.75 minus 22,460.15. So 2,77,008.60 into 7.5 percentage. So it is 20775.65. Please write down answer. Now, as far as the first year factor is concerned, it is 0.909 and so on. So first year factor is 909. Second year it is 826. Third year it is 751. Third year it is 683. So over here we'll compute the depreciation present value, that is depreciation into present value factor. So here 26250 into 0.909, that comes to 23,861.24. 24281.25 into 0.826, that comes to 20,056.31. 22460.15 into 0.751, 16867.57, 20775.65 into 0.683, 14189.77. So 23861.25 plus 20056.31 plus 16867.57 plus 14189.77, that comes to 74,974.90. This is the present value of the incremental depreciation. Step number 3, terminal cash flow. We understand that over here the question is providing that, say, if at all we continue with old machinery, then in that case it will not have any realizable value after 4 years of its useful life. However, the new machinery will have the sale value of 35,000. So that is what we understand is the cash inflow at the end of the 4th year. We have to ignore capital gain tax. So write down terminal cash flow. In that, existing machinery and new machinery. Scrap value, it is 0. And over here, the scrap value is an amount of rupees 35,000. So incremental terminal cash flow is 35,000. No working capital. It is year 4 end. Step number 4, calculation of recurring cash flow. Of course, it would be the incremental. So existing machinery and new machinery. I request you to make the calculation of profit before depreciation and taxation, or you may compute profit before depreciation after taxation. Working note number 1, calculation of profit before depreciation after taxation. Please do it for the existing machinery and put your answer in the chat box. So here we have to work out the answer taking into account the information given. It is the sales value, material cost, labor cost, variable overhead, fixed overhead. These things will be considered and these things will be ignored. And based on that, so we'll make the calculation of the profit before depreciation and taxation, and then it will be converted into post-tax term. So please write down answer. Sales, it is 8,10,000. Direct material, 1,80,000. Direct labor, 1,35,000. Then it is variable overhead. It is an amount of 56250. Then fixed overhead. It is an amount of 90,000. So from revenue, all these will be deducted. 8 lakh 10,000 minus 1 lakh 80,000 minus 135 minus 56250 minus 90,000. So 3 lakh 48,750. That will be converted into post-tax term. Income tax rate is provided to us as 30%. We can see that the tax rate is 30%. So profit before depreciation after taxation. So into 0.7, that is 244,125. Similarly, we have to work out for the new machinery. For the new machinery is again 8 lakh 10,000. Next is 126,250. Next it is 1 lakh 10,000. Next it is 47,500. Next it is 97,500. So it is 8 lakh 10,000 minus 126,250 minus 1 lakh 10,000 minus 47,500 minus 97,500. So 428,750 into 0.7, that is 300,125. So that will give us incremental profit before depreciation after taxation. That is difference of this two, 56,000. So if at all we replace existing machinery, there is an increase in the profit before depreciation and after taxation. That will be calculated as 428,750. I'm sorry, 3,125,000 minus 244,125. This will be received from end of year 1 to end of year 4. Now in step number 5, calculate NPV and put your answer in the chat box. Step number 5 is NPV. In that, year 1, 2, year 3 and 4th year, incremental profit before depreciation after taxes. Last year we will get the incremental terminal cash flow, net cash flow, discounting at the rate of 10% and then present value. From present value of the cash inflow, investment is deducted to compute the NPV. In that we will add present value of the depreciation tax saving, that is present value of the depreciation into tax rate. So profit before depreciation after taxation is an amount of rupees 56,000. End of year 1 to end of year 4. The amount of the terminal cash flow is 35,000. Net cash flow 56,000. And this is 91,000. Discounting at the rate of 10% for first 3 years factor. So it is year 1 to year 3 and last year it is 0.683. One, two, three factor summation 909, 826, 751, 2.486. $56,000 into 2.486, 1,39,216. 91,000 into 0.683, 62,153. That will give us the present value of the cash inflow, 139,216. So 2,01,369 plus present value of Depreciation tax savings. Present value of the depreciation has already been found by us. It is 74,974.90. 74,974.90. Income tax rate is 30%. 22,492.47. Total present value of the cash inflow 2,01,369. So it is 2,23,861.47. Less investment. Dear students, amount of the investment has already been found by us in step number 1. Amount of investment is 3,50,000. So investment is negative 3,50,000. Based on that, NPV is calculated. Minus 3,50,000. So it is 1,26,138.53. We understand it says since NPV is negative, the company is advised not to replace the existing machinery. So the decision as NPV is negative, comma, do not replace existing machinery. Full stop. This is the way we can have the answer. So summary of the entire answer. In step number 1, we will write the investment, that is purchase of the new machinery 4,50,000 less sale existing machinery for 1 lakh. So we will have say 3,50,000 year 0 cash outflow. Step number 2, incremental depreciation. In that first working note is incremental value of the block 3,50,000. Then present value of the incremental depreciation. We compute the depreciation and present value of the same. Step number 3, terminal cash flow is very simple. 35,000 from the new machinery and 0 from the existing machinery. Step number 4, recurring cash flow. In that very simple, profit before depreciation after taxation. So the incremental value is 56,000. In NPV calculation, year 1 to year 4 cash flow 56,000 will remain same. Fourth year we will receive the terminal cash flow. Total of both of them is the net cash flow. Then it will be discounted at 10%. Then importantly, present value of the depreciation tax saving is present value of the depreciation into tax rate. Total from that the investment is deducted. Unfortunately, NPV is negative. So we will advise the company not to replace the existing machinery.